Hey everyone, it's MJ, and in this video, I want to talk about capitalism, communism, active and passive investing. Now, I find capitalism and communism an interesting discussion because it seems to evoke quite a lot of emotions in people, and you kind of see this online. Some people are very, very much against capitalism, others are very, very much against communism. And I see that there's also a lot of disagreement in, what actually is the difference between the two. We kind of see, private ownership with capitalism, and we kind of see public ownership with communism. But what I wanted to do was look at how do these two philosophies or modes of economics relate to investing. And so I don't know if I'm oversimplifying it here, but I kind of see capitalism, well, the goal of capitalism is to allocate capital efficiently. And the goal of communism is to allocate capital evenly. And I want to come and touch back on this a little bit later when we start talking about index funds and how to construct passive portfolios. But there's always like a story that I kind of heard as a child. And it goes something like this. Let's call it a little village or a little town, and there's only so many flutes, and the people need to decide how should we distribute the flutes. And there's two competing ideas. The one idea is, well, let's give the flutes to the people who make the best music, the best musicians. And the other idea is, well, let's break up the flutes so that we have enough flutes for everyone. We might make a lot of noise, and the flutes might not play the best music, but everybody is going to be able to be creative and make a sound. Now, which one is the better one to do? And it comes down to priorities. I mean, if you want to listen to the best music, it's better to give the flute to the best music players. But if you want everyone to be happy and you don't want people to fight, then giving everybody their own little flute, even though you had to break them and they're not going to make such a beautiful sound, at least people are getting that enjoyment. And I think it's very difficult to decide which goal or which objective is better, specifically from a morally point of view. What is more desirable? Everyone having fun or better music being played? And we kind of see this, in kindergarten, where the teachers will share things evenly so that all the children are happy and not necessarily, worry about getting the best outcome. And kind of see this when, I remember when I was at school in the early grades and we did like a school production, everyone kind of got a chance to sing or, have a little bit of center stage, where when I got into my final years of school, those roles were preserved for the best singers, because then the production quality was very important. We had an audience who didn't think we were just cute, and they weren't prepared to tolerate us just having fun. They wanted to be entertained themselves. And of course, there's that other famous story that comes from the Bible, where it speaks about a master who gives a bunch of coins to a bunch of servants, and he comes back and he sees, how did the servants do? And the ones who made the highest return, he says, congratulations. And the one who make the lowest returns, he takes the money away from them and gives it to the top performers. And this is, of course, interesting. Because when it comes to finance or to investing, we want to maximize our returns. This is one of the goals of finance, is making money. And we kind of see that when it comes to investing, the stocks that are performing, or our investments that are performing the worst, there might be a good trading strategy and to take the money away from that, sell whatever you have of that and put it more towards the top performers. Of course, stocks get a little bit interesting, and or that's very much known as the momentum strategy. And some people say, no, hold on, the contrarian view is to take money away from the winners and to put the money down back at the losers. And like I said, this is where we slowly start coming to the active and passive side of the video, because like I say, capitalism's goal is to allocate. Capitalism's goal is to allocate capital efficiently, and communism's goal is to allocate capital evenly. And when we come to look at, say, passive investing, this is when you invest without thinking, or the belief is that the amount of money or time it takes to research stocks isn't actually going to give you better performance because the market is efficient. You still need to make a decision on how you're going to, allocate your funds. Do you just randomly pick stocks? Do you put all money just on one stock? Or do you try and tap into something known as diversification? And the two main theories that comes with diversification, and I guess there's a third that tries to mix the two together, is you have the one where you say, okay, let's look at market cap. We're going to look at market cap, and the bigger the company is, the bigger the share, or the bigger part of my portfolio that I'm going to invest in it. And then you have the other type, which says, no, in order to maximize diversification benefit, let's give an even amount to each stock. And like I say, this very much sounds a little bit like capitalism and communism. And it's interesting to see that both approaches are heavily criticized. And this is the lovely thing about finance, is that it depends, and we struggle to find an exact answer, and it very much depends on a bunch of other economic factors and your investment objectives and liabilities and all these other things. But let's kind of look at some of the criticisms around these two methods of passive investing. So the one approach is to say, let's buy shares according to their market cap. So if there's two shares in the market, the one has got a market cap of 90%, the other one's 10%, or 9 million and 1 million, you would then give 90% of your money to the bigger company and 10% to the smaller company. And this one gets criticized that says, well, then the bigger just keep getting bigger, and the bigger they get, the more inefficient they become, or they become overpriced. And this is one thing that people tend to criticize about capitalism, is that the rich get richer without really doing much, because this is passive investing, is you're allocating capital. What you think is efficiently is based on the past. So you say, because this company was the biggest in the past, therefore they're probably going to be the biggest in the future, and you give most of your money to the biggest player, and essentially they can sit back and relax, and they're just going to reap more and more money. And this is something that we saw in the Bible story. The guy who made the most return in the last season gets given more money to try and make money in the future. Of course, the past is no indication of future performance, and who knows, the Bible doesn't have part 2 of that story to see if that investor did the best in the second season as well. And there's a lot of studies, specifically around hedge funds, that show that asset managers, or these hedge fund managers who did well in the previous season, didn't necessarily do that well in the following season, and they kind of showed that there was a lot of this random fluctuation. And passive investors surprisingly point to that as one of their justifications for investing passively, because they say, look, the active managers aren't consistently at the top, and they're always jumping around the place. Therefore, why waste fees on them? We're just going to buy according to this formula, and this formula is that we give more money to the past winners. So there's a little bit of a hypocrisy over there, which, like I say, it's interesting. But then you've got the other approach, which is the communist approach almost, which is to give your money evenly. So if there's 10 shares and you've got $10, you give each share $1. Where this gets interesting is that you start overinflating the bottom side of the market. You start assigning too much value to them, because let's say the big market cap, they've got a lot of shares, they've got a lot of supply so that they can meet the demand. But if you come and you start dishing out shares or stop, investing evenly, the lower shares, there isn't enough supply of those shares to meet the even demand. And what that's going to do, it's going to distort. The bottom shares are actually going to be pushed up. And this is where it gets, again, and this is where people complain about communism, is that they say, well, the problem with communism is that people are just going to be lazy. They're going to do nothing, especially the people who aren't productive. They're just going to enjoy the fruits of the benefits of everybody else. And like I say, it's interesting that you get with the investing according to market cap. The capitalist approach is you're benefiting the bigger players and you're making them larger and incentivizing them to be lazy. But with the other approach, the communist approach, where you're investing your money evenly, you're then getting you're then incentivizing the smaller companies, not necessarily to be, I guess to be lazy in the sense that you're overinflating those type of shares. And of course, this is where the active managers then come in and they say, you know what, if the market is dominated by passive investors, there's going to be distortion at both the top end and the bottom end. And therefore, whenever there's distortion or market inefficiencies, by doing superior stock selection, we can actually generate a higher return for the same level of risk. And that's like the holy grail of investing, is to get more return at the same risk or even at a lower risk. So active managers come in and they buy their shares and they do all these type of things. And if they do generate an excessive amount of return, they feel justified in charging a higher fee. And what seems to happen is, let's say there's passive investors have dominated the market and there is all of this market inefficiency. Then what tends to happen is a lot of active managers start entering the game because, wow, they can make a lot of fees and it's quite easy because of all the price distortions. But the mere act of actively trading kind of makes the market efficient. So the more active investors that start interacting with the market, the more efficient it becomes, the harder it is to get excessive returns. And also competition means more active investors, money is split across them and they're not getting their fees. So they kind of get smacked on both sides. They've got more competition and there's less fruit. So there's more people picking and the trees are producing less fruit. It's a double smack. So much so that it gets to the stage that, because a lot of them still kind of charge their high fees because they're spending a lot of time and energy in doing all of this, that once this starts happening and the market has too many active investors and it starts becoming too efficient, the passive investors can return and they can say, listen here, guys, it doesn't matter what stocks we buy, if we even buy according to market cap or just do equally allocated, we can actually make higher return. Not that we're going to beat the active investors, because no one can beat anyone. It's just that because we're going to charge a lower fee, because we're not doing any work, we're just simply buying according to a formula rather than researching, we can put this cost saving towards the client. We can actually generate a higher return through the passive approach. And then it's kind of the cycle repeats. All the money then gets taken and given to the passive funds, and they start buying according to their formulas. And in time, as passive controls the market, market inefficiency comes up again, and the active investors suddenly, there's the fruit is back on the tree and they can start picking. And because there's been this drought for them, a lot of the competition has gone out. So once again, it's like, ta-da, it's happy days for them. And we kind of see this sway happening with active and passive investing. And like I said, it's an interesting approach, especially when you look at passive investing, because what is the best way to invest passively? Is it the capitalism approach of give the money to the highest market cap, or is it the communist approach, which is give the money evenly across? And they both kind of assume that by buying a bunch of shares, through the act of diversification, that they're reducing their risk. And this is something which I think they're incorrect at. I don't think just buying a spread is, or a bunch of different stocks or putting your eggs in different baskets is the ultimate way to reduce risk. I think we actually should be a lot more active in how we reduce risk. We should put in like a simple risk management framework. Companies should say, hey, first of all, companies should become aware of risk. Should become aware of risk. They should create a risk profile with some risk objectives and actually set about identifying risks, measuring risks, managing risks, then looking how does this shape our risk profile, and then monitoring risks. And I think if companies started doing that, then we would actually see better return for everyone. Because there's this crazy idea, and I don't think anyone like really subscribes to it now, but there was this crazy idea that said the individual companies should not manage their risk at all. They should not manage their risk at all, because the shareholders, who are the ultimate owners of these companies, and companies are designed purely for the shareholder, they should seek to take on as much risk as possible, because the shareholder can, spread his risk through diversification. Of course, they incorrectly assumed that risk was simply just variance or volatility of returns, and they didn't understand, the probability of ruin, and that if that risk event occurs, then that company's wiped out and they don't get to play the next time. So it's kind of crazy how our understanding of risk will kind of shape how we invest. But you can see I don't know, I'm just thinking out loud. Not really sure, what to do. I'm getting to that stage where I'm thinking, okay, how should I invest? Do I invest actively? Do I invest passively? And if it's actively, because that's the thing with active investors. There's guys who, chase growth. There's guys who chase value. There's the momentum, the contrarian. There's all these different active philosophies, but there's also passive philosophy. So it's a difficult decision, because you have to choose which side, or you have to kind of figure out where the market is. And it definitely is, it's got me scratching my head. Here I am, I studied finance, and I really don't know how to invest money in today's economy. Like, is it overvalued? Are there some, value pockets out there that I can tap into? So I basically wanted to make this video to start a conversation and hear what your guys' thoughts are. So I don't know, where are you guys investing? What are you doing with your money? If you don't have any money to invest, but you were to suddenly get some money, where would you invest? Let me know in the comment section below. Because that's one thing I like about this YouTube channel is I always like to tell people I've got the smartest YouTube audience in the world. And so I'd love to hear your guys' thoughts around where you're investing. And especially in today's climate, like, tell me what country you're in, whether you're going passive, whether you're going active, and then depending on which one you're going, like what subtype, like, what type of active, what type of passive, what asset classes are you looking at, what are your investment objectives, how do you see risk? There's a lot to be said about this. So looking forward to engaging with you guys, and like always, let me know in the comment section below, and thanks for watching. Have a great week. Cheers.